Okay, I think that's probably everybody. So we'll start into it. And so hello and welcome to our webinar on the impact of COVID-19 on tax residency. My name is Philip from Nathan Trust, and we really appreciate you taking the time to participate in our webinar today. I'll shortly pass you over to David Bruton, who heads up our international tax team. David and is dealing with this on a daily basis with all our clients, with a good number of our clients. In this webinar, we'll discuss the concepts around tax and non-domicile, tax residency and non-domicile. We'll then explore the current position of the Irish government as a result of the COVID-19 crisis and some concerns we have around this. It's complicated. There's a Q&A, so please let us know your questions. If we don't get to them during the webinar, we'll address them afterwards. So all your questions are greatly appreciated, and we'll also send a copy of this presentation around to everybody who signed up to the webinar, and we'll put the video of the webinar on our website and on YouTube as well. So there'll be lots of time to catch up with it. So without any further ado, I'll hand you over to David. Do you want to take it, Dave?
Thanks, and hi everyone. I suppose before we get into the details of how COVID-19 is impacting on tax residency, what we wanted to do was maybe just give a bit of background information on when you're considered Irish tax resident, what domicile is, the different tax positions based on your residency, your domicile, and also ordinary residency. So I suppose to start, the basic position is, you know, when are you considered Irish tax resident or when you're not considered Irish tax resident. So the first step, I suppose, is you look at the Irish domestic legislation. So that says if you're in the country for more than 183 days in any calendar year, you're tax resident in that year. And also they've got what they call a look back test. So if in the current year and the preceding year, you're here from 280 days or more with a minimum of 30 days in either of those years, then you're also considered resident in the tax year in question. So with the tax residency, I suppose the other aspect of that is the double tax agreements. So double tax agreements between Ireland and other countries take precedence over domestic legislation. So if you had a scenario where you were also considered tax resident in another jurisdiction, you would just need to look at that because that could supersede the Irish rules. And so it can be relevant in a lot of people's cases. So domicile would be the next aspect to look at. It's domicile is one of those things that it's hard to define, but it's, you know it when you see it. So it's your domicile is the country with which you have your closest connection. That would generally be the test. It's not necessarily where you were born. When you are born, you have a domicile of origin. You take that from your parents initially. So, you know, what would their domicile be? You take that. So if you were born to, say, two British parents in South Africa, you would have a British domicile of origin initially. You can then obtain a domicile of choice. So that would be where you become resident in a new country and you intend to reside there permanently. That residency would be more about having a permanent home available to you there rather than the 183-day test. It would also imply that you've severed all connections with your country of previous domicile, and that can be hard to demonstrate. There's a number of factors you'd look at. So I suppose where are your personal connections, your business connections, social connections, where are they strongest? What are your intentions about where you'll reside in the future would be very important. Where do your spouse and your children reside if you're married and you have children? Do you spend periods in the country of your previous domicile? Have you made a statement of intent, or either written or oral? And you know, one of the more unusual aspects you'd look at is where a person plans on being buried when they die. Domicile isn't defined anywhere in the legislation. It's been guided by case law over the years. So there's been some unusual cases in it, and intention is a big part of it. So there have been cases where someone could have lived in a country for a very long time, but because they had a stated intention to return to their original country, their domicile would never have changed. They would have always remained with their original country and wouldn't have changed to the country they may have lived in for the majority of their life. So I suppose the next question then is, if you're living in Ireland and you're a non-domiciled individual, what are what are you taxable on? So it's your Irish source income you're taxable on, your worldwide income to the extent you remit it into Ireland, and any foreign employment income where you carry out the duties of that foreign employment in Ireland. For capital gains, it's Irish gains again, and it's worldwide gains to the extent that you remit them into Ireland. So one of the I suppose the big benefits of being non-domiciled, there's two real main benefits to it. One is that even though you're not domiciled here, you are a tax resident, so you get the benefit of all of Ireland's double tax agreements with other countries, and there's 80 odd of those. So that with that, because you're only taxed on your remittance and your Irish source income, you can very much manage your exposure to Irish tax, and generally you can manage your exposure to tax worldwide in most cases. There are exceptions. So that's, I suppose, the concept of domicile and how you're taxed as a non-domiciled individual in Ireland. So I suppose looking at someone who's Irish domiciled then as opposed to a non-domiciled individual, how are they taxed? So before you look at that, we just need to look at one further concept, and that's ordinary residency. So a person is considered ordinarily resident in Ireland if they've been tax resident in Ireland for the 3 preceding years. They then keep that status until they've been non-tax resident in Ireland for the 3 preceding years before a year in question again. And ordinary residency is a very peculiar tax concept to Ireland. You don't find it in other countries at all. So looking at a couple of scenarios for Irish domiciled individuals. So if you had an Irish domiciled individual who's not resident, and they're not ordinarily resident here, so they're living abroad and have been doing so for a number of years, they're taxed on their Irish source income only. And for capital gains tax, their exposure would be to gains on Irish specified assets. Irish specified assets is generally assets deriving their value from land and buildings in the state. If you're looking at an Irish domiciled individual, they're not resident, but they are ordinarily resident. So they're no longer tax resident in Ireland, but they haven't lost that ordinary residency yet. So they've been abroad for maybe 2-3 years, but haven't gone to the 4th year yet. They're taxable on their worldwide income, except for self-employed income from a business carried on abroad, where no part of it's carried on in Ireland, employment income where they carry out all of the duties abroad, and other foreign income if it's greater than 3,810 euros. Capital gains tax, they're liable to worldwide CGT on worldwide gains. So the last, I suppose, Irish scenario, the Irish domicile scenario then is if you have someone who's Irish domiciled and they're tax resident in Ireland, whether they're ordinarily resident or not, they're subject to income tax on their worldwide income, capital gains tax on their worldwide gains. So that's very different from a scenario where you have an Irish domiciled person who's not resident and not ordinarily resident. And we'll go into why that's important with COVID-19 in a little bit. So looking at how COVID-19 might impact on the above, and there's a couple of scenarios I suppose we've either come across from questions raised by clients or have occurred to us as we're looking at the guidance. So if you had an Irish domiciled individual who didn't expect to be tax resident in Ireland in 2020, but due to COVID-19, they're now here and they're now unable to leave. So this might be someone who was home on a holiday, someone who's got elderly parents here and has decided to come back and check on them, but they're now not able to leave. You also have, I suppose, individuals who are on assignment from abroad, working in Ireland, maybe expected to be here for a very limited amount of time, and that's now been extended because of lockdown. You have individuals who are resident in Ireland but normally commute to work abroad. So for example, if you had someone who lived in Dublin but worked in London, you know, flying over on a Monday morning, flying home on a Friday evening. How will this impact on them? You also have non-domiciled individuals who are tax resident in Ireland, you know, but I suppose maybe abroad at the moment. So if you take an example of a German national who's tax resident here, not domiciled, they're in Germany at the moment and they now can't return to Ireland at the moment, how will this impact them? So Revenue do have guidance out on a lot of scenarios. It doesn't cover everything, but the Revenue guidance at the moment talk about the force majeure provisions. So looking at Revenue's guidance and what it says, so what Revenue says, where an individual is prevented from leaving the state on their intended date of departure, due to...
Sorry, Dave, just what I was going across is that the concept force majeure, what does it actually mean? It's a legal concept, is it?
Yeah, I suppose from a tax point of view, what it means is, I suppose, something that's outside of your control that you could do nothing about, and it's almost seen as unfair that it would impact on you in this scenario.
Okay, so when Revenue uses the phrase force majeure, they're saying that things that are outside your control. That's
yeah.
Their...
I suppose historically how we would have come across it with tax residency in particular is it would have been a much more limited idea, and you wouldn't really have come across it much in day-to-day life or a wide application. It would have been, say, someone who was managing their tax residency quite carefully and counting days, flying in and out of the country. So let's say they were due to depart on a Sunday night because that extra day might have impacted them if they were here on the Monday. And the aeroplane can't leave because there's been an engine failure or something like that, and it's the last flight out on a Sunday night and they can't leave. So the force majeure provisions would say that's outside of your control. There's nothing you could do about it. You had every intention of being out of the country on the Monday. You're now flying out on the Monday. They won't count the Monday as being a day you're resident in Ireland. So I suppose the application of it to COVID-19, what they're saying is that, again, it's where you're prevented from leaving the state on your intended date of departure and you're unavoidably present in the state because of COVID-19. So looking at the wording there, I think there's a couple of things you can read into. So the fact that you're prevented from leaving, it's not that you choose not to. So it's you know, there's an external aspect to it. You needed to have an intention to leave the state. So if someone has come back and said, well, I'm intending on being here for the duration of COVID-19, that's different to someone intending to leave but being prevented from doing so. And as well as that, they talk about your intended date of departure. So let's say, for example, if your intended date of departure was the 1st of April and you had the opportunity to leave earlier, but you'd always intended leaving on the 1st of April, there's no obligation on you to have tried to get out of the country earlier based on that wording. I suppose the whole force majeure provision raises a couple of questions in my mind. So again, when are you prevented from leaving the state? Is it, you know, when you decide that it's not reasonable for you to do so anymore? And scenario would come across there is, let's say, someone living in a third world country who has doubts about security in that country or the health service in that country, and they've decided that it's more beneficial for them to stay in Ireland for the time being. Is it when you're no longer able to travel? So for example, the flights just aren't there anymore. You can't fly into the country you live in, or you can't fly out of Ireland. It's open to interpretation, I suppose. There's no specific guidance from Revenue on that, but I would be cautious on it. And again, I suppose, taking it a step further, when are you no longer prevented from leaving the state? Again, no specific guidance on that, but I wouldn't expect Revenue to kind of look into the future and try and give you guidance on that at the moment. What I would,
if you take the example of the UK, where like you can still fly and get a boat to the UK.
Yeah.
And if you're over here working for a couple of weeks and you were forced to stay here because you look after your parents or someone or for whatever reason, do you think it's reasonable to say that you shouldn't go back to the UK, or it was forced majeure, the fact that you couldn't go back to the UK?
I would think so, depending on the circumstances. So what I would say there is, if you, let's say if you take someone who's, I don't know, working in the City of London in finance and they can work remotely, they've got a laptop with them and they're able to work from wherever they are in Ireland. What I would say is look at the rules in force in Ireland. So I suppose the whole lockdown, you're not really supposed to be going outside of your 5 kilometre radius now, except for essential travel. Is your travel then essential? So again, the Department of Foreign Affairs are saying you should avoid all non-essential travel, full stop, except Northern Ireland, I think is the only exception. And they've got specific countries that they're saying do not travel to. So I know Italy's on that list, for example, but the UK doesn't fall into that do not travel list. It's more the non-essential travel. So if that person is able to work remotely from Ireland and they don't necessarily need to be in the UK, then to me, the trip they would have to take to get home to the UK would be non-essential, and you'd be in breach of the rules. So I would think they could legitimately say that they're prevented from traveling at the moment due to COVID-19 restrictions, and force majeure would apply to them.
Okay.
So I suppose what the force majeure rules say is that for the day in question, the day after you intended leaving, you're not considered to be in Ireland. And so that would apply for the duration of the restrictions preventing you from travel. So looking at how that might impact on a couple of scenarios. So if we look at, say, an Irish domiciled individual who's not resident here and they're employed abroad, so they would normally work and live in a different country and they've returned to Ireland, they're now unable to travel back to their normal country and they're working remotely from Ireland. So I suppose to take non-COVID-19 type scenario, how would they normally be treated? So, you know, let's say take someone who's traveled home from the UK for 2 weeks of holidays and they're picking up emails and you know, maybe fielding a few calls from the office. You know, there'd be no issue there. They wouldn't be considered to be taxable in Ireland in any way. If you had someone who's traveling here for a longer period, they may need to portion their income between Ireland and the UK, for example. You know, if they were going to spend a part of the year here, that may come into play depending on the length of time. But if you take someone who's now in Ireland and they're going to be here longer term because of COVID-19, and I suppose the big thing is it's you know, none of us can put a timeline on this in terms of when it will end and they'll be allowed travel again. There's 2 questions to answer. One is, do they become tax resident in Ireland? And then if they've got employment income, is that considered Irish source income if they're sitting in a house somewhere in Ireland and they're working on their laptop and doing that work? So the first question, I suppose, are they tax resident in Ireland? So you look at the force majeure provisions and you say, well, here are the days that I'm prevented from traveling, returning home to where I live in the UK or wherever else it might be. And you disregard those from the days you're present in Ireland, so you don't count them in looking at whether you're in Ireland for the 183 days or not. So for most of those people, you know, if they travel back as soon as they're no longer prevented from doing so, the days they've been here will be disregarded from when they were prevented from traveling.
Just a question, when you talk about the force majeure for people who are stuck here, might have been on 2 weeks holidays or so, what about the scenario, which I think is probably the majority of cases, where people actually came home to Ireland because there was a general sense of, oh, you know, let's get home, it's probably better, or stay for whatever reason, and they've actually voluntarily come back to Ireland, and now they might have thought they'd be here for 4 or 5 weeks, but they could be here for 4 or 5 months.
I suppose what you would have to do there is go back and look at the wording of the revenues interpretation, and they're saying you look at your intended date of departure, and if you're prevented from traveling from the following day, you're no longer, or those days are disregarded. So I suppose if you take the scenario of the person who said, I'm going to travel back to Ireland for, let's say, 4 weeks and I'll just see how this goes, and so I'm traveling home on the 1st of March and I'm going to travel back on the 1st of April. 1st of April is their intended departure date, so you count from then. You don't count from the 1st of March when they return home. If they're
what defines a intended departure date? Is it a return ticket? What happens if you got a one-way ticket?
I suppose return ticket would be, you know, pretty categoric if you've communicated it to your office. If it's, you know, I suppose it's, if you can, again, it's intention. So if you intended to return on a particular date, and if you can demonstrate that concretely, all the better. So if you can show an airline ticket, if you can show emails back to the office saying, look, I'm working remotely from Ireland for the next 4 weeks. I'm going to be back in the office from whatever date. Anything like that, I think, would be demonstration of your intention, but really it's your intended date of departure. So how you demonstrate it, I suppose, will depend on the circumstances. So that's I suppose the tax residency aspect of it. The second part of it, in my mind, is even if that person is not tax resident, would their employment be considered an Irish source income because they're doing that work in Ireland? So to me, the revenue guidance isn't 100% clear on that, but work carried out in those days, you're not considered to be in Ireland on those days. So I would think that would bring it outside of the tax net in Ireland, that it wouldn't be considered Irish source income. The next scenario we looked at was an Irish domiciled person, non-resident in Ireland, and they're self-employed as opposed to an employee. The treatment here is slightly different. So again, I suppose the scenario we're looking at is someone who normally resides abroad, carries on a business abroad as a self-employed individual, and they've returned to Ireland, now unable to travel back, and they're having to do their work from Ireland. They're carry on their business from Ireland. So again, looking at, you know, a normal scenario, if they were here on a 1-2 week visit, whatever it might be, and they're fielding emails and calls, you know, during their holiday, there'd be no tax issue there. Again, if they were here on a longer term basis, it's a little bit trickier than, say, for an employee. Their business income could be fully taxable in Ireland. So revenue's stated position is, if you carry on a business, a trade, partly in Ireland, partly abroad, or if you control it from Ireland, they view that as an Irish trade. It's an Irish source income. It's taxable here. So that's normal circumstances. So again, to look at COVID-19 circumstances, you have the same two questions. Is the person considered tax resident here? Exactly the same provisions apply. You disregard the days from when their intended date of travel back, when they're prevented from traveling, and you disregard those in looking at your 183-day test. In terms of the business income, is it Irish source income? Again, guidance isn't 100% clear, but I think roughly the same treatment applies, in that the person for those days with force majeure provisions is considered to not be in Ireland. So to my mind, at least, there's a very strong argument for saying if the person isn't in Ireland according to the force majeure rules for tax purposes, then the business isn't carried on here. But revenues guidance doesn't specifically address that that scenario. So the next scenario we looked at is a person who works partly in Ireland and partly abroad. I suppose where we would come across this in practice is maybe where you've got someone who works for a company maybe involved in infrastructure or something like that, and they're maybe working for a foreign company under a foreign contract of employment, but they're maybe working here on a particular project for a portion of time, or they're you know, they're in and out of the country. And in a lot of scenarios, what you'd be looking at there is you'd be looking at that person apportioning part of their income to Ireland and part of their income to abroad, and it would be based on their work patterns. So what revenue said there is you look to their normal apportion, or you look to their normal work patterns, and you apportion accordingly. So you disregard the fact that they're stuck in Ireland and having to work here because of COVID-19. You'd want to be good in terms of documenting the normal work patterns there and be able to demonstrate it if it was challenged, I would think. But that's revenue stated position, so it's a bit more categoric there. Our next scenario was an individual who commutes to work abroad, and I suppose there's two different people here, or two different types of people who might be impacted here. So again, we're kind of saying person who flies out of Dublin on a Monday morning and back on a Friday evening. I know there's quite a few of those. Looking at a person who's non-domiciled first. So let's say you take, I don't know, a German national who's working for a hedge fund in London. They fly out to Dublin. on a Monday morning and back on a Friday evening. In normal circumstances, that person probably would not be taxable in Ireland in the first instance on their income, because it's a foreign employment. All of the work is done abroad. They earn the income abroad. They're non-domiciled. Revenue's guidance doesn't address that person's scenario. So I suppose with COVID-19, they're now carrying out their work here. They're working from home off their laptop. In normal circumstances, that person would be within the tax net because they're carrying out the duties of their foreign employment within Ireland. It's unclear with COVID-19. They may or may not be covered by the force majeure provisions. It's, again, you know, you might be able to argue that they were intending being out of the country on the Monday morning, back on the Friday evening, but it's I would think that's one that you'd want to be careful of, and that may require pretty close attention if someone was falling into that category.
Just on those two different scenarios. So you've got one which is the person who's working 9 to 5, say they're leaving Dublin or Cork, going to the UK and working Monday to Friday, 9 to 5. They're, in all probability, they're paying tax in the UK.
Mm-hmm.
So that's position A, and now they're probably going to become, because like at a minimum they're going to be here 3 months, say, they're now going to be tax resident in Ireland because they're probably here for holidays and weekends, but they are paying, and they're clearly identified as people who pay income tax to HMRC in the UK.
Mm-hmm.
And then you've got the person who's not paying any tax at all,
Mm-hmm.
because they're resident in Ireland, domiciled in Ireland, resident in Ireland, earning their money either abroad or foreign, but they don't pay any tax at all. So they're two quite distinctly different scenarios, aren't they? Like you'd certainly be more worried about the latter than you would about the former. You
would. I mean, the first scenario, they may still have a slight tax exposure because you find that the income tax levels in the UK are slightly less than Ireland. So they'd get it, you know, if they were now taxable in Ireland, but they were also taxable in the UK, they'd get a credit for the UK tax, but they'd pay the difference to revenue in Ireland. So they'd have a slight exposure, but certainly the person who, for whatever reason, doesn't have any tax liability on their income up to now, but now it's potentially within the Irish tax net, they could have a nasty tax liability.
Whose responsibility is it to address this? If, like, in scenario A, if the person's PAYE in the UK and they fall into the Irish tax net through residency, do they need to deal with this individually, or does their UK company need to deal with it?
In a lot of cases, I suppose the revenue give guidance on when an employer should be applying the payroll system. But even if the employer has an obligation to do it, if you take a business that's solely UK based and they've 1 or 2 Irish employees and they've no real presence here in normal circumstances, if that employer doesn't fulfill their obligation, then, you know, it doesn't absolve the individual from paying their tax on that income if they're taxable on it. So that's your I suppose non-dom who's living in Ireland commuting. If you're talking about a person who's Irish domiciled and they're in the same scenario where they're commuting over and back, in normal circumstances they would be taxable in Ireland and taxable in the UK, but they'd benefit from what's called Transborder worker relief, and Revenue have said that that treatment can continue to apply. So again, you'd kind of treat them as if they were commuting normally. You ignore the fact that they're stuck in Ireland because of COVID-19. So I suppose the other scenario that's very relevant here is if you take a non-domiciled individual who is normally tax resident in Ireland and is making use of that non-domiciled status, and they're now stuck abroad. So the scenario I suppose we were considering was, take for example, you know, I don't know, a German individual who is normally resident in Ireland, resides here, you know, more or less year round, but they're back in Germany at the moment and they now can't return to Ireland. So they may not clock up their number of days in Ireland to be considered tax resident in 2020 because of COVID-19. And in their case, I mean, there's no guidance from Revenue on this. And I suppose there's two aspects to it. One, they need to look at what the German tax rules would say, or what the rules in whatever the country is. The second aspect then is that you look at the Irish side of it. If they're not clocking up the number of days, there is a provision in the Irish legislation that says you can elect to become tax resident. The stipulation there is that you need to be coming here with the intention and be able to demonstrate that you're going to be tax resident in the following year. So if you had someone who was living here up to 2019 and in 2020 because of COVID-19, they're not going to clock up the required number of days. You look at the you look at that provision and you say, well, they're intending on being here in 2021. So for 2020, they need to get into the country in 2020, but they're electing to be tax resident for 2020, and they need to make a written election to revenue. It has to be done. You know, you can't do it in 2021. It needs to be done in 2020. But that would potentially solve that problem for that type of person. Company tax residency, Revenue put out some guidance on this. So generally speaking, where a company's tax resident it hinges on where the central management and control is exercised. And what Revenue said is that if you take a scenario where a director or employee, key employee of a company is present in Ireland purely because of COVID-19 restrictions, they won't look to establish that that company is now tax resident in Ireland. So I suppose to take a very obvious scenario, if you take a one-person company and they normally operate from France, and that person is now in Ireland because of COVID-19 and they can't return to France where the business normally operates, but again, they're fielding emails, calls and doing their work here in the short term, Revenue won't look to say, well, that company is now tax resident here. Equally, where if you had an Irish owner-managed company and that Irish director is stuck in the UK because of COVID-19, Revenue said we won't look to, we won't see that company is no longer tax resident in Ireland. And I suppose in general terms then, whatever your scenario, if you're impacted by COVID-19 travel restrictions and it's impacting on your residency, or if you have any doubts, what we would say is you should document your decisions in real time. So, you know, when were you unable to travel and why? So it might have been because you're looking at the Department of Foreign Affairs travel guidance. It might have been because you couldn't get flights from Ireland to your country of residency. But whatever the scenario is, documented in real time. And then I suppose, you know, just look at your scenario and see, are there any aspects of it that warrant some further attention that really need to be looked into, where Revenue's guidance doesn't clearly address your scenario, and there are you know, a number of people who will fall into that category. With Revenue, I mean, a question we get from people sometimes is, you know, should we approach Revenue for an opinion on this? And what I would say there is, if your scenario is very clearly addressed by their guidance, then probably no. If your scenario isn't clearly addressed, then potentially yes. Our experience, you know, we would have approached Revenue quite a bit over the years on different scenarios, particularly where it's more unusual, and our experience with them would be that they do generally try to give you their honest interpretation of the rules. They don't just look to bring someone into the tax net, so to speak. What they would expect is that you've done your homework on this in the first instance and you've done your very best to try and figure it out, and that there's maybe some particular aspect of it that isn't clearly addressed by the legislation or by their guidance, and you're looking for clarity on that. I would say it's probably not a quick process. If you go to Revenue looking for technical interpretation on something or guidance on a technical matter, it tends to take a bit of time. And when you're approaching Revenue, the more specific you can be with your circumstances, the homework you've done on what the guidance and the legislation says, and what particular aspect you're looking at, the more precise you can be, the better chance you have of getting back an answer specifically addressing your scenario. If you approach them with a very generic kind of question, there's a good chance they'll just come back and say, you know, refer to our guidance, it covers this. I think that kind of, that covers.
Just a couple of questions. One is that there's not, from Marie, there's not pan-European or OECD guidelines where all the different tax authorities are approaching this from the same perspective. They're not all sharing an opinion on how to deal with this?
Not that I've heard. I mean, you do have you do have OECD guidance on tax treaties and the like, but in terms of, I suppose you only get to the tax treaty after you've looked at the domestic legislation. So, you know, double tax treaty only comes into play in terms of tax residency if two countries are claiming a person or a company is tax resident. If one company, or sorry, if one country is claiming it and the other one isn't, then you've no recourse to a double tax agreement, because you don't have a scenario where there's going to be double tax. But I suppose to answer the question, no, there's no guidance that kind of says all countries in the EU or all countries in the OECD will treat people in such and such a way in terms of tax residency.
Do double taxation agreements deal with pandemic scenarios at all? Has that come up?
I don't think so. I don't ever remember coming across it in any of them. They don't make easy. They don't make easy reading.
They're all about 600 pages long, and they haven't managed to deal with pandemics.
No, yeah.
Okay, I think that's it. There's no more questions coming in. There was a few that came in as I was we were doing it, so that's a couple of my interjections were related to that. So I think that's it. We've been about 30-35 minutes. So thanks again for everybody for their time. David, thanks for giving us your wisdom on it. Again, we'll send an email out to everybody that's registered with the link to the webinar, and it'll be on the website, and we'll share the presentation as well. So thanks again for your time, and keep washing your hands.